Good afternoon and welcome to Real Wealth Network's weekly webinar. Very excited to present to you opportunity zones or qualified opportunity zones, a new provision in the tax law that pretty much nobody really understands yet. So we're going to try to get an understanding of it on today's webinar as much as we can at this point, because there's a lot that is still being defined. And who better than our personal attorney and an attorney who's helped many of our members with asset protection, but also with taxes. So to have somebody who understands both tax law and asset protection is a huge bonus. So Clint Coons, welcome. We're so happy to have you here.
Great. Thanks for having me on. This is going to be good. Like you said, there's a lot of information out there, some of it misinformation. So I'm glad you're bringing this to your clients so they can understand what to look out for and where the opportunities lie.
I'm excited personally because some of the areas that we've already been investing in are now zoned as an opportunity zone. So we're already doing business there. So can we take some additional benefits? So yeah, let's see what you got here. I usually read this, but I'm going to let you do it since you're the attorney.
Okay, basically it says this, that anything we talk about in this presentation is not appropriate for everyone, and other options mentioned may be more suitable for your specific circumstances. Consult your personal accountant, tax advisor, and or attorneys to discuss your specific situation. And of course, past performance is no guarantee of future results. Real estate purchases are subject to investment risk, including the possible loss of amounts invested. While every effort is made to maintain accurate and current information, the possibility of errors and or updates always exists. I think the last thing we forgot to put in here is that, by following this advice, you may get cancer. You may not be able to sleep at night.
All right. Well, maybe you can help us come up with a better disclaimer.
No, I think it's great. It's like what you see on TV when you're watching those drug ads. This is a great drug, but if you take it, you're probably going to die.
Right. It'll help one thing, but it might kill you along the way. And that's true for some of these fads, shall we say. I mean, I don't know that this is a fad, but this is a very exciting opportunity. But what comes with that is a lot of people who actually have no idea what they're talking about. So we wanted to get you on here to straighten it out because, as you've said, what we talked about just offline a minute ago, you've been to different real estate events where people are saying things that may or may not be true.
Yeah, that's correct. Yeah. And so it's great about your upcoming tours.
Yeah, so we have a couple of upcoming tours. One is just this weekend, so it might be late for some people, but we have a development in Park City, and we actually have our company retreat in Park City. So we thought we'd stay Saturday and just kind of take a tour of the development we have there. And we have about, 20 investors who are going to join us, people who are involved in the project or just want to see one of our subdivisions. And that will be on Saturday the 6th. You can find out more about that on our website at realwealthnetwork.com/tours. And then Chicago on Saturday the 13th, I will be there for that. And we're going to be touring single and multifamily properties in Chicago. And some of them are already located in this qualified opportunity zone. And so we would like to understand the potential tax benefits as a possible addition to an already good investment. So that's why we're here today. And then we have an upcoming live event, Saturday, October 20th in San Mateo from 12 to 3, Sunday the 21st from 2 to 5, and Monday from 6 to 9 in San Diego. The focus will be on income properties in Jacksonville and Tampa at our October event. So we hope to see you there.
And there's me. So those of you who don't know me, I'm one of the founding partners of Anderson Law Group and Business Advisors. We have a few offices across the country in Washington State, in Las Vegas, Nevada, and then one in Cheyenne, Wyoming. And we focus primarily on real estate investors and their tax planning, asset protection, and business planning needs. The way I often refer to it is that think of investing as a three-legged stool, and that you really need to look at all three legs of what it is you're doing. So many professionals will just look at the asset protection leg of that stool, and they think that that's all they need to focus on, where others may look at the tax planning leg and just focus on that. And I can tell you from firsthand experience, I did that myself. When I first started practicing, 2 years into my practice, I was focused only on the tax planning leg of the stool. And to that end, when I prepared a tax return, my CPA gave it to me and he said, "Oh, Clint, you owe $175,000. And I thought, oh my gosh. So I went down and I looked at my return with my partner and we went through it. And we took what was $175,000 owing the IRS and turned it into a situation where they owed us about $85,000. We brought it back to our CPA and we showed it to him. We said, "Hey, can we do this?" And he said, "Yeah, absolutely, because that's a creative way of looking at things. We can definitely do that." And so that's what I did for 4 years. And I thought I was the smartest guy out there, teaching everyone that, hey, you can set your business up this way. And if you account for your income, you won't have to pay any tax. And what I missed out on was the fact is I was not putting myself in a situation where I could grow my business. And it taught me something. It's something that we relay to our clients now, is that by focusing it just on that tax leg, I was missing out on the business aspect of building my real estate portfolio. I mean, now I have over 100 properties, and it took me, I mean, a lot of that as growth has come in the last 6 years of being focused on it, because prior to that, whenever I'd go in to borrow money, they would ask to see a copy of my tax return. And what would it show? I made no money. And then I have to turn around and explain to the bank, "Oh, you can't trust my tax returns." And they look at me and they think, "Oh, so you cheat on your taxes." And so it just got to be this problem that I realized you can't focus on one leg. You really have to look at all three. And at Anderson, we do that for our investor clients. We want to look at asset protection, tax, and the business planning aspect of it to help you move the ball down the field to get to where your end zone is.
And I got to tell you, Rich and I have been looking for you all our lives. We're so happy to be working with you for that very reason. What I found over the years is almost every attorney has a different opinion. Every CPA has a different opinion. Many are not tying their approach to the other, and it all affects each other. So yeah, we love what you do and what you're bringing to our members.
Thanks. Okay. So what is an opportunity zone? Well, really what it is, these are economically distressed areas in every state. And what the government decided to do is incentivize investment into these areas, to bring jobs into these areas, to help bring these people up and get them into the workforce. And so we oftentimes use the tax code to incentivize investment in certain areas. Remember, the GO zone was one of those where they wanted people to go down into certain areas that were hard hit by hurricane and spur investment there to help rebuild it. And so tax incentives were provided. This is another extension of that now. By creating these areas, we are looking to stimulate growth there. And the way the government does that through the tax laws, they will give you certain tax benefits that ordinarily you wouldn't be able to obtain any other way. And of course, that then creates opportunities for us if we know how the game is played. And so what is the opportunity zone? What is it designed to provide to you? Well, there's really three aspects under the tax code that are attractive to investors who invest in these zones. Number one, you're going to get gain deferral on the sale of an asset. Then you're going to get partial forgiveness of that gain at a later date, depending on the length of time that you hold it. And then on top of that, they're telling you, well, if you hold it for a certain period of time, we'll forgive all additional gains from that investment whenever you sell it. So there's a lot of incentives that have been built in that you have to meet certain carrying requirements as far as holding it for a set period of time. But at the end of the day, if you're making an investment into here, you're going to find there's going to be a substantial tax savings, especially if you're leveraging those investments. Your return is going to go up even further, or you can get even higher on the types of investments that are made into these zones. And a few of the calculations that I've done personally really show that investing in the gains is good, but leveraged investing is even better under this opportunity zone benefit that we have now under the tax code. So one of the questions I get a lot is, well, Clint, how does the opportunity zone, this deferral of gain and everything compare to 1031 exchanges? Because that's what most of us are familiar with. That we've been taught that, the only way to defer recognition of income on the sale of an asset, or for example, real estate, is to engage in a 1031 exchange. And those have further been restricted with the changes in the tax law at the end of 2017. And so right now, if you wanted to engage in a 1031, what you would have to do is you'd have to roll all of those gains from the sale of real estate into other real estate. So it has to be truly like kind, which under the old provision of the law, there was some wiggle room there. You didn't really have to go from a house to a house. You could move into other things. So with 1031 exchanges, typically what happens is that you have to roll the entire amount. So if I sold a piece of property for, say, $600,000 and my adjusted tax basis in that property was $300,000, then in order to avoid paying any tax on the sale of that asset, I would have to roll the entire $600K into this new investment. I could roll more, but I have to at least roll that $600K in. Now, a problem for real estate investors many times is the fact that much of our real estate is leveraged. And when you're rolling into a new investment, not only do you have to roll the gains and your basis, you also have to roll whatever leverage you have on that property. So in my example, if I'd borrowed $200,000 for that investment and that mortgage is still on the property, that mortgage has to go. So I have to roll that $600,000 into that new investment. So that made it hard for some people to enter into 1031 exchanges because of the debt component. And so maybe they wouldn't get the full benefit of the exchange because they would pay off the mortgage and they couldn't get another loan on the new asset they were rolling into. And so then they would have to have partial gain recognition. Now, eventually too, with a 1031 exchange, the only way out, that is, so you don't have to pay taxes. I mean, because there is a way with a 1031 where you'll never have to pay taxes on any of your future gains. So you could do a 1031 for 30 years and defer gain and then finally sell the asset and never have to pay taxes on it. But that out is not something that most people are willing to accept. That is, you have to die. And then you can get out of paying any tax, because when your children inherit it, they get a full step up in basis. So with the 1031, it's beneficial, but it really doesn't have the zing that these opportunity zones provide. Because with an opportunity zone, you don't have to worry about so much the like kind anymore. And what you're allowed to do is roll the gains, just the gains. You don't have to roll anything other than the gains into the new investment. It doesn't have to be all the gains. It could be a portion of the gains. It's basically, hey, whatever you want to roll, we're going to give you tax deferral on the amount that you roll in to the new investment. And then if you hold it for a set period of times, and I'll show you this in more detail later on, you're going to get a tax exclusion. That is when you sell that asset. Unlike a 1031 where you can't sell it without recognizing the gain, with an opportunity zone investment, I'm just going to call them OZ investments. With an OZ investment, then when you sell that asset, you don't have to pay any of the gain on the sale of that asset. So any depreciation that occurs from the time you take possession of that asset, if you hold it for 10 years, it'll be completely tax-free to you. Now, there is a limitation though with these investments. Of course, they have to be in an OZ zone. So that's different from a 1031, which you can go all across the United States. You're not limited on where you make the roll. So, 1031s still have their place for certain individuals, but the opportunity zone has to be in a specific zone, which we're going to cover. And then we do have a similar rollover period with the OZ and the 1031, in that if you're going to roll into it, you have to roll within 180 days. So you have to find your property and roll into it. Now, unlike a 1031 exchange where you have to work through a qualified intermediary and they have to hold all your funds, so you're restricted, and you have to identify property within 45 days, you don't have to do any of that. This is really basically, we trust you, go out there, sell your property, you can take all the funds, and as long as you roll it in with 180 days and you certify it to us, we're good to go, and you're fine as well. So it's really freed up the restrictions that many people see with 1031s as far as dotting the I's and crossing the T's to ensure that it will be a compliant 1031 exchange. With an OZ, we don't have those same types of restrictions. You're free to sell the property the way you normally would and then take those funds. And it doesn't have to be the exact matching funds. If you sold a piece of property, and as I'm going to also explain in a second, the types of gains here, you only have to receive money. As long as you have money that equates to whatever your taxable gain is, and it gets rolled into a new investment in an OZ area, you're good, and you can get this tax deferral that we'll be talking about. Now, what is gain? So this is a question that comes up a lot. Does it have to be just real estate? Well, the fact of the matter is, any gain will qualify. So you could sell stock. If you have stock in Apple, Boom, you sell that, you make $500,000, that qualifies. So you could just roll that $500,000 gain you made from the sale of your stock into an opportunity zone and defer income tax recognition on that sale of stock. If you have real estate that you sold, that would qualify. If you sold a business, that would qualify. So this is what we're talking about, is actual gains, where money has come in, it's hit your account, and you're just going to turn around, you're going to roll those gains in to an opportunity zone fund. Now, you also have the ability to roll phantom gain in. Now, some of you may not be aware what phantom gain is, but it's a situation where you could be invested in an asset and you have to recognize gain for tax purposes, but you don't necessarily receive cash. Here's a perfect example of that. Let's say you get involved in a syndication, and the syndication produces for you $100,000 in income, but that income isn't distributed to you. Okay, so an asset that gains there, the asset's been sold, but they don't distribute the gain to you because they're going to reinvest it in another property. Well, that gain you could look at as being phantom gain, that you have to pay tax on that money, but you're not actually receiving it because it's left inside of that private placement or syndication. So in that case, because you had $100,000, you could turn around, take that $100,000, if you have that money sitting around another account, invest that money into an opportunity zone, and you wouldn't have to pay tax then on that phantom gain that was kicked down to you. Another planning opportunity I see is for certain real estate investors. If you have real estate that is currently held, let's say a S corporation, one of the problems that we've had with investors in the past and working with them where they've acquired real estate and it's in their business, and their business is an S corporation, is that if they deed it out to themselves, that is treated as a taxable event. So they have to pay taxes on the difference between their adjusted basis in the property and its fair market value. So assume that you have a business or you have an LLC that's taxed as an S corp and it owns a piece of property. You purchase this property for $300,000. It's now worth $800,000. If you just deeded that property to yourself, it's treated as a deemed sale, and you have $500,000 now in income, even though you didn't get the cash. That would be taxable to you. It would be treated as a sale. So let's assume that I had $500,000 sitting in an account somewhere. This would give me the opportunity to do as follows. Deed that property to myself. Now the property would have to recognize $500,000 in gain. So that's going to increase my basis in that property from the $300,000 to $800,000. Now just that alone, think of the opportunities there. You've been depreciating that property at a $300,000 cost basis. Now you've jumped it to $800,000 for depreciation purposes. So what is that going to do to your taxable income from that investment? It's going to significantly reduce your taxable income because your depreciation now gets fully stepped up. So where you were maybe showing $15,000 in depreciation before, now you may be showing $45,000 in depreciation. So you'll be taking in an extra $30,000 in income tax-free every year just from this maneuver. Now, in order to avoid taxes on that $500,000, of course, you have to have that sitting on the sidelines. You would take that money, roll it into the opportunity zone, make an investment there of the $500,000, and then that deemed sale that you would have been attributed to, that you would have had to pay tax on, now it's deferred. So you're able to escape taxation, bump the depreciation, the basis in your property up to its full fair market value. So I see there's an opportunity for certain investors who have assets in entities that would treat them, they have a low cost basis, and they're looking for a way to increase that cost basis because they've seen significant appreciation in their particular area, to look at how an opportunity zone could work together in this phantom gain arena. All right, so
Wow.
How does the deferral work? Yeah, isn't that pretty cool? That's something.
Unbelievable. We do have
Yeah.
phantom income in some of our developments because we build houses and the government sees that as, okay, you built a house and sold it, but we're using the proceeds to build another house, and investors do receive phantom income. So we definitely need to talk about
I thought
that.
you might like that one.
I really like that, and I can't wait to understand it better.
Yeah, that's why I threw it in. That was for you. Okay. So the period of taxable gain deferral. Okay, so how long can you defer the gain? So in my example, with that 500,000, basically you get to defer it all the way up until December 31st of 2026, or if you sell it anytime between now and December 31st of 2026. So if you roll into the asset and you don't sell it and you're holding on to it on January 1st of 2027, that deferral will be taxed to you at that time. So there's two different components here we're looking at. We're looking at the amount of income that you're deferring from the sale of your existing asset. And then we're also going to be looking at the amount of appreciation on the asset you roll into and the tax-free nature of that. So the way they determine how much tax you're going to pay in 2026, it's either going to be the lesser of the amount of gain deferred. So in my case, it was $500,000, or the fair market value of the investment in the qualified opportunity fund minus your basis in that fund's interest. Because remember, you could roll money in yourself. So if I invested into a fund, I brought in the $500,000, and I also brought in $200,000 in as well with the 500, then my tax basis is going to be $200,000. I do not have a $500 or $700,000 tax basis because I never paid tax on that $500K. And so really what I think they tried to set up with this recognition treatment here is by giving you the lesser of, what it's doing for you is protecting you against loss. So if you roll into an OZ area and your investment into that area, let's say, forget about bringing in any outside cash. All you did was put in gain, 500K. If that asset's value decreases, say it goes from 500 down to 300, then you're going to get hit on $300,000 of taxable income, not the $500,000. So it also protects you from risk of loss, that if the investment drops in value, you don't have to pay taxes on that original amount you rolled in. You're only going to have to pay taxes on the asset's value at the time. So there is, further incentive for people to take on this risk, that they're not worrying about getting involved in something where, hey, yeah, I'm going to defer it, but if the asset goes down and I lose money, then I'm going to be paying tax on a much higher value. So that's a nice aspect that they built into this provision of the code. So partial forgiveness and forgiveness of additional gains. So let's look at an example here. Let's say you sell an asset in 2018, and then you invest that asset within the 180-day period. If you hold that for 5 years, then you're going to get a basis increase. And so this is what I was talking about earlier, where they threw in some other bells and whistles here. They're going to increase your basis in the asset by 10%. Now, this is technical stuff here. We need to put on our CPA hat basically to describe it. But think of it this way. If I rolled in my $500,000, that all it does is constitute gain from another asset, then my tax basis in that is currently zero because I never paid tax on that money. Well, what this is telling you is that if you hold it for 5 years, they're going to give you a 10% increase in your tax basis. They're going to treat it as if you paid tax on 10% of that $500,000 when you originally sold the asset. And then if you hold it for another 2 years, then they're going to give you another 5% basis increase on the sale of that, on that gain that you rolled in to the investment. And then if you held it for 10 years, okay, then when you sell it after 10 years, your basis in that asset will be the sale price of the asset. So if you bought it and you sold it later on for millions of dollars more, that's going to be your basis. So you'll pay no tax. So it looks like this. Here's the sample investment. Let's say I have a sale, generates $1 million in capital gain. I turn around and I buy an asset within 180 days. I roll all that capital gains into this investment, $1 million. Now, if I hold on to this for 5 years, then my basis, at that point in time, is going to increase, okay? If I hold on to it for 5 years, it's going to go up to $100,000. Now, why is that? Because remember I said you get that 10% increase. So now I started with a zero basis in that $1 million. Now I've got a $100,000 basis. So if I sold it in 2023, my taxable gain from that income deferral is going to be based on $900K, not the initial $1 million, because I put that money to use and I held on to that investment for that requisite 5-year period. If I hold on to it for another 2 years, well, then my basis will go up to the $150K, because that's an additional 5%. So now I'm only going to pay tax on $850,000 of that $1 million that was deferred. And then on December 31st, of course, of 2026, at that point in time, you have to recognize that income. Now, here's something to keep in mind. I know a lot of people, have been looking at this, and I've been fielding several phone calls from our clients. And one of the things I have to remind them is that, hey, the tax bill will come due on December 31st, 2026. So you need to plan for that. So whatever you're rolling in, if it's $1 million and you plan to hold it up until 2026, then you need to figure out what your potential tax liability will be at that point in time, and putting some cash aside to pay the tax, because you're going to get hit with that bill at that time, because you're getting a deferral on the amount of gains you're rolling in. You're not eliminating the gains. The elimination comes from the sale and the appreciation of the asset itself, not on the deferral of the original gains you roll in. So then if I held it for the full 10 years and the asset's value has now doubled, so it's worth $2 million, if I were to sell it on June 30th of 2028, so I held it for the requisite 10-year period, if it's worth $2 million, then what I have is $1 million in appreciation, because I bought it for $1 million with the deferred gains, and now it's grown to $2 million. If I sold it that year, then I would pay zero tax on that $1 million in appreciation. So if you think about it, that's basically a $200,000 tax benefit you're receiving there, assuming the tax rate is at 20% cap gains rate at that period in time. So that is a big incentive for people to invest in opportunity zones. Now, where are these zones? Where are they located? So here's what happened. At the beginning of the year, the Treasury told states, you need to identify certain districts or areas in your state that will qualify as stressed areas to meet the laws or the regulations we have as what we want for opportunity zones. And then you send them into Treasury, and then we will certify those. So that process went on for approximately 5 to 6 months. Every state sent them in, and then they identified these areas. And so now they've all been certified. So we know where all the zones are in the United States. Now, for example, here's a Texas opportunity zone right here. And you see all the little blue areas in the map? I just pulled this up off the site. You can see if you were to invest in any of these blue areas, that would be considered an opportunity zone area, and that would be eligible for the roll of your gain. Now, if you want to figure out where the opportunity zone lies, if you're looking at an investment, I've provided you a website right here, the cdifund.gov/whatever, you can read it. If you go to that website, you can then search every state in the United States, it breaks it all down for you. This is on my desktop. This is one of my hot links that I save in my browser. And when we're dealing with a client, we're talking about an investment opportunity. I'll say, what we should do is let's just run it through here. And so we'll go to the website. I'll go to the website and I'll punch in the address, because you can punch in the address and it'll tell you whether or not it's in a zone, and it'll bring it up on the map, and you can see how close you are to the zone as well. And so maybe that would be a determining factor if you say, all right, well, if I go across the street, I fall into the zone. Well, maybe I'll look for an investment on the other side of the street to save something on taxes when it's later sold. So it's great. The work's all been done for us. Just got to know where to find it, and this is where you can go to figure that out. Now, qualified opportunity zones, it's going to remain in effect through December 31st, 2028. We'll see if Congress extends that. It depends on what happens with the changeover in the midterms and what's going to happen 2 years later, if they try to go in and repeal some of these benefits. But for now, we're through 2028. Hopefully they'll extend it, because this goes back to Reagan era economics. I don't know if you remember Jack Kemp. He was a strong proponent of creating these types of areas in the United States to spur development in areas where we want to help bring people up, create jobs for them. So what is this qualified opportunity fund I've been talking about? Because for many of you, if you're a real estate investor, you can go in and you can make the investment yourself. But one of the things that we always talk about at Anderson is that when you're investing, you should invest through limited liability companies or corporations, depending on what it is you're doing. So making that type of investment is important from an asset protection standpoint. Well, if you want to do that, that's actually called a fund. And now it's not like the fund you're thinking about, where you have to deal with a securities attorney and you have to put together a PPM. It's got to be a syndication. No. All you have to do is create an LLC that's taxed as a partnership, or you have a corporation. And as long as it's stated purpose, so we have to draft the operating agreement, which states that its purpose is to invest in an opportunity zone, and 90% of its assets are held in an opportunity zone, then you qualify. And this is extremely easy threshold to meet. And one thing that I need to warn you about is that for sure you do not want to use an existing LLC that you have. So you've already set up a limited liability company, it owns a property or two inside of it, you would never use that LLC to make this type of investment. This has to be a special purpose entity that's set up specifically for an opportunity zone investment. So you're not commingling non-OZ assets with OZ assets, because if you do that, you're going to blow your entire deal. Now, you have to get it certified as well. So as I stated, corporation, partnership, each of those will work. LLC, that is taxed as a partnership. And there's this asset test that I talked about here. You got to hold 90% of the assets in OZ property in order for it to qualify as a certified fund. Now, people, again, you're probably wondering, well, how do I make it a fund? Well, it's actually quite easy. It's self-certification, all right? So there's no approval needed or action by the IRS is required. What you got to do is complete this form. Now, I'd love to tell you or show you a copy of the form right now, but with everything with Treasury, as I'm about to get into in a minute, they've been really slow on addressing issues with respect to the opportunity zone investments. So I've been telling people, if you want to make the investment in an OZ area, we'll set up the LLC, we'll put the requisite language in there so that it passes the test. But as far as the certification process, you're just going to have to wait until the IRS, gets off the stool and actually puts something together. And right now, you can, this is the IRS's website on opportunity zones and the certification process. We were expecting it. They said it should be out by this summer. And, the way I look at it, it's now October 1st. Summer is over, and they missed that deadline. So now it comes down to hopefully they'll have it within the next couple months or so, definitely before the end of the year. And all it is a form you have to fill out. There's nothing else. They're not going to come and ask you for your LLC documents or anything like that. You just have to certify that the assets are held in an opportunity zone area, right? And this LLC actually was set up to do that, and you're good to go. All right, so let's talk about the types of investments that you're going to make, all right, from opportunity zones. Well, one of the things that is really crystal clear in the law is that it's designed for business, that they want you to set up a business in that area, all right? And you can open a business in an opportunity zone, and you have to make sure that, at least 50% of the income is derived from active conduct as well. So not passive, it's got to be active conduct of a business. And so, for example, let's say that I was investing in commercial property. One of the issues that I think that may come up for commercial real estate is that, how do you make commercial real estate, active conduct of a trade or business? Well, you have to show that you're actively involved in the running of that real estate. So I think that triple net leases, for instance, may not work out so well for individuals who are using commercial because that really puts everything on the tenant to maintain the property. And so you may have to avoid triple nets in putting leases together with commercial property to make sure that you meet this active conduct test. So you have the, you can also go in there, you can lease property in an opportunity zone for use in the business, and that's going to qualify. So let's say I was a dentist and I wanted to open up a dental practice and I was leasing property for that. All that money that I use for that would qualify as long as that property is used in the opportunity zone. So this is the business aspect of it, of creating an active business. Now, many of us are real estate investors, so we don't necessarily, we're not necessarily looking to create an active business. And there's certain things that they specifically put into the law that you cannot do, what they call sin businesses. I've listed them here, but I mean, it goes without saying, you know, I think, you know, if you're going to, you want to sell dope or something like that, if you live in a state that permits cannabis, I don't think that's going to qualify, even though they didn't list it there. You wouldn't be able to do that. So there's certain areas they don't want things within the community that they feel would, you know, influence people to engage in bad behavior or destructive behavior. And then also what they're looking for is they don't want there to be businesses that gentrify the neighborhood, that are really designed just to benefit wealthy individuals and won't help the individuals that actually live in that area. So I can see the intent behind this, and so that's why they specifically excluded certain types of businesses that tend to, you know, gravitate to lower income areas. Take the golf course out of it, but you can, you know, the country club, but you know, a lot of these, you drive through a depressed area and you're going to see many places like this there. All right, so what we have then is when you're investing into that area, it's got to be, as I talked about, it can be tangible property that's used in a trade or business. You got to acquire a property though from an unrelated party. So you can't be selling property to yourself and trying to roll gains into your own property and get this to work. It's got to be from an unrelated party. And during the holding period, you know, substantially all the use is within the qualified opportunity zone, of course. And then it's got to be original use. Okay, so this is something that where we get into the weeds now with respect to the real estate aspect. So there's two sides of the coin with real estate, and we're waiting on guidance from Treasury to really come in and define how real estate investment in an opportunity zone will apply for the rollover and deferral of gains. One thing I think that is evidently clear in every commentator that I've listened to or read on this subject, because, you know, I'm curious about it, and so I'm paying attention to big CPA firms that are releasing white papers, reading those, trying to get what the consensus is amongst other professionals. And everything that I've read and listened to, the consensus is as follows. If you're going to come into an OZ area and you're going to develop, all right, so if it's raw land, you're going to develop, not a problem. That is what they call original use. So that this was land, and now we're going to turn it into something else: commercial, residential, multifamily. Whatever money you roll in is going to be fine. So I think there's great opportunities there for people who want to put together, you know, syndication. And if you're going to go into an area and you're going to revitalize it and you're going to tear stuff down and build some multifamily there, create some Section 8, I don't think there's anything that's going to disqualify you from meeting that. Now, with respect to property that is a not original use property, so it's existing use property, this is where we hit the cloudy part of the code in what they were intending. What was the intent of Congress here that Treasury has to define for us? So if it's existing use property, now we're looking at a single family home, all right, in a opportunity zone area. You invest into that single family home, and you're going to treat it as a single family home after the fact. So it was a rental before, or, you know, a single family home, now I'm going to rent it out. That would qualify as existing use. Now, the only way I think you could just on that investment alone turn it into something other than existing use property is to maybe possibly Airbnb the property, because with an Airbnb, now we're looking at a situation where it's a business, and so it would definitely qualify under the first provision or intended use of the opportunity zone. That is, are you going to be running a business there? Airbnb meets that definition of an active trade or business. So if you bought a property there and you used it as an Airbnb, you don't have to worry about this point I'm going to make next. But let's say we don't. Let's say we buy a multifamily, or we buy a single family home. Well, then I think the way the code reads right now is it's going to have to be a value add proposition. That if you buy that property, then you're going to have to substantially improve that property. And so people have asked, well, what does it mean by substantial improvement? If I buy a piece of property for $50,000 and I put $15,000 into it, did I substantially improve it? Well, just like everything in the tax code, what makes it so complex for us is that you draw from other interpretations of other statutes, of other provisions to try to discern what this word means, because it was not defined. So substantial improvement, the consensus is, if you buy a piece of property for $50,000, then in order to substantially improve it, you need to do a value add of $50,001 for it to qualify. And you have 30 months to do that. So, for example, if I bought a home in a distressed area in an opportunity zone and I got into that house for $15,000, and believe me, this isn't that difficult to do in many of these areas. I myself, and as I said, I own over 100 properties, and many of them have been purchased like this, where I will buy them for $15,000 and I'll come in and I'll put in $25,000, and I'll take that property. It was collecting $250 a month rent. Now I'm getting $800 a month rent. So this works. I mean, you can do this. It's just a matter of when you're buying the property. Is the work being done before you buy it, or are you buying it and then having the work done, and then of course you're paying for it as you go along? That would be substantial improvement. So you have this 30 months where it will be evaluated to see if you substantially improve the property over that time. So I think, the intent there is pretty consistent with what they're looking for with these neighborhoods. I mean, you think of, Detroit, certain areas of Chicago, these homes, they don't want them to be a blight on the community. So if they can get an investor to go in, turn around that property and invest into it, double their investment into the property, then they want to encourage that, because that's going to improve the neighborhoods. And by improving the neighborhoods, hopefully it's going to improve the lives of those individuals that live in those neighborhoods. Give them a sense of home ownership, a sense of respect for what it is, just for themselves as an individual. So this issue, though, is still not clearly defined. And as Kathy and I were talking about before we started this, and we wanted to get this information out, is there are people out there that are just throwing around the words, oh, come and just buy the property and it qualifies because it's in an opportunity zone and you're going to get the deferral on it. I'm a little more cautious on that because we're still waiting on Treasury to give us their final determination on how that's going to play out with OZ zone property. But I think the substantial improvement is how I would feel most comfortable in doing one of these deals. And so that may be negotiation when you're going in, who you're working with, to make that work out. So on paper, it would meet this substantial improvement test. So this is just a recap of that existing use. I gave you the example there. So I'm not going to go through that again since we just talked about it, original versus existing use property. So with that, questions and comments. Kathy, do you have anything you'd curious about on that?
I do. So let's say Real Wealth Network started a fund, and we went into an area that was an opportunity zone, and we were buying single family homes, and let's say improving them and making them duplexes or fourplexes. Would that qualify? It sounds like it would, but what if it's passive for the investor, but it's their money that's active? Does that make sense?
Yeah. I don't see a problem with that. I think it's going to qualify. So in that type of deal, So in a lot of syndications, I mean, you've been doing this, you've had a lot of success in it. What you typically do in the syndication is you come in, you do your value add, and then you hold the property for a set period of time, and you say, all right, we're going to sell it at this date. What I see occurring here now is that you're going to be holding that property though for 10 years to get the full advantage, especially if you're trying to attract investors with the tax deferral aspect of it. Because if the fund dumps the investment within year 3, then all of a sudden all that gain is going to be taxable to me. I got a 3-year deferral, but I really didn't get the full, 15% increase in basis and then the full tax-free exchange at the end of the 10-year holding period that the investor may be looking for. So I think it's going to, in a deal like that where you're doing a syndication, it could be kind of tricky for the syndicator on how they put together that PPM, that offering, so that all parties are fully aware that, you can roll the gain in, but you may not get the 5 or 7 year deferral. I would never want to lock myself in if I was a syndicator into a deal where if I saw that area, going down and I'm going to lose money on the investment. I want to get out now while the out's good. I would sell it and reap my gains, pay tax on my gains, but the investor needs to know that, you were not guaranteed this tax benefit.
You make such a great point, because basically what we're doing is going into depressed areas. Now, if a whole bunch of investors come in and improve that area, there's a really good chance that values will be higher. But that's not always the case. That's not always the case. And we've gone into some areas that took longer to turn around than we thought, and there might be high crime. And like you said, perhaps the syndicator says, wow, this area is not getting better. And in everybody's best interest, we need to sell regardless of tax benefits. Very, very important point. And one I wanted to bring up that you and I talked about earlier is no matter what the tax benefits are, the investment has to be a good one. That's more important than the tax benefit, right?
Absolutely. I mean, it's something again, we'll take Airbnb, for example. I watch several people tout Airbnb as better than single family, that you can make so much money at it. And you're right, you can make money at Airbnb, but they oversell the benefits, and people then run their numbers on the Airbnb income, and they do not run their numbers on traditional rental income for that area. And so they make these investments. And the problem with that is that unless you're investing in an area where you know exactly 100%, here's what the laws are in this area. Say I'm using Airbnb as an example. With Airbnb properties, then you can somewhat rely upon that. But remember, they can always change it. And counties or cities are more quickly to change regulations than the federal government is. So when you make that investment, if they turn on you and they outlaw Airbnb, and this is actually what happened, a few of my clients in the Boston Back Bay area, they did this and they got into issues. So you have to be really careful there, because once they pulled that Airbnb out, they were done. Those properties now could not justify the mortgage because they were not making the type of income they needed. Does that make sense?
Absolutely. And just going back, I guess at least 10 years to the GO zone, whenever you've got amazing tax benefits, you get all kinds of people running in to make a profit, and not everyone is worthy of your money. So we saw all kinds of people going in to develop who didn't have the experience in development or didn't truly understand the tax law. And we saw people going in and losing money on the deal, even if they potentially could get the tax benefit. So it's not worth it. And like you and I talked about, people already now are talking without really truly understanding this new tax benefit. And that's partly because the final word isn't in on how it works. But one thing that I think that is very clear is that you can't just go in and buy a rental property. That's not enough.
Correct.
Yeah. And
you got to do more.
You got to do more. You've got to improve it, possibly as much as you put in. Did I hear that right? So if you bought $100,000 property, you have to put at least 100,000 in?
That's what it would appear. Yes, it's $101.
Okay.
But I mean, that's not there. That happens all the time because when you work with a wholesaler, or not a wholesaler, but let's say you work with an individual in that area that buys properties and then sells them to investors. Because I myself have done many deals like that. Oftentimes, I come in at the back end, so I'll be buying the property after it's fully rehabbed. Whereas if I was one of those individuals, I would just change my agreement with the investor. I'd say, all right, here's what I'm going to do. I'm selling you the property at this price, but I'm locking in a contract to do the rehab work at this price with you.
Mm-hmm.
So you have to use me for the rehab. So then the investor in those communities, they get the amount of money that they were hoping to get. And then for the person, the developer, but for the investor, they get the tax deferral. So it can be a win-win situation. What it's going to have to do is just change the way these guys typically operate and the way they think of things when they're working with investors.
Absolutely.
Actually, now that we talk about it, I think I got some investors I need to be or developers I need to be calling.
Me too. No, this is really exciting stuff. And one of the things, it's my favorite kind of investing, because right now people have this opportunity to sell some overpriced assets or some assets where they've made a lot of gain. And they can take that gain and go into an area that's just at the beginning of what could be a boom in those areas. So I love this opportunity.
I mean, it's like stocks. I mean, how many times have you probably sat down with someone, they've got a great portfolio, they've experienced all this run up and they want to get into real estate, but they know if they sold their stock, they're going to take a hit. And so that stops them from moving out of that investment into real estate. Now they've eliminated that problem for them.
It will be interesting to see if what the impact might be on the stock market as more investors take their money out. Yeah, something to keep in mind. All right. Any last comments, Clint? You just, oh, well, here we go. Our tour, you can check that out at realwealthnetwork.com/tours. If you would like to meet our developer in the Park City area and see our subdivision there, you can join us on Saturday, October 6th. And then I will also be in Chicago on the 13th for our tour there of some opportunity zones where you could definitely put in enough rehab, the same amount of rehab as the purchase price. So very exciting.
Easy.
Yeah.
All right. And then again, you've got your events just as a run by. And then people have, if they want to learn more, if they want to set up a strategy session, if they go to realwealthap.com, I've got an ebook you can download. And if you wanted to set up a session to talk about creating an LLC that qualifies an opportunity zone fund or just protecting the assets in general, definitely check out the site.
Thank you so much. Thank you. Wonderful. And also on our site, you can get the Anderson Advisors contact information under the resources tab. All right. Thank you so much.
Great. Nice talking to you.
All right. Take care. Bye-bye.
Bye-bye.
And thank you all for joining me here for our weekly webinar. You can listen to this and any past webinars under the Learn tab at realwealthnetwork.com. Have a great rest of your day. Bye-bye.